Okay, everyone, welcome to another episode of Line Your Own Pockets, where we're continuing to go down this kind of basic backtesting and systematic trading mini series. This question actually comes from a user, so as always, we love users' questions, and essentially talking about using watch lists or stock universes and whether or not that makes sense. So, when you're building a system, should you look at every stock in the market, or just the S&P 500 or the Nasdaq 100 or Russell 3000 or any of these individual sides of things. Now, in the last episode, me and Dave did a lot of time agreeing with each other, so that's why we did this one now, because I think there might be some disagreements when it comes to the difference between day trading and swing trading. So, first of all, why don't you give your answer, Dave? Again, knowing that this is from what you do, which is kind of exclusively day trading.
Yeah, so this question comes from a guy that I've been working with named Roger, like the thesaurus.
Mhm.
Um, Super interesting guy, very technical guy. Um, has a like he's all about optimization, and that's his background from a different field. And he's really getting into strategy development, and he had this very good question. Should I be filtering my universe based on inclusion in the S&P 500. He started off that way, and then he moved to the Wilshire 5000, which I don't know much about. I don't know much about any of these lists really, but which is kind of, I think, very interesting to talk about, because I think that's a really important thing. You don't know, like, you're sort of outsourcing the inclusion of these things
Yeah.
to somebody else, so you don't really know why they're in there. So that in itself, to me, is a red flag, because I talk a lot about what's your path to confidence, and if that's almost like a little black box. If you're using a starting point that you don't really have full control over, like you're basically outsourcing the logic, you can't really know why the stock isn't in there, then that's already sort of a red flag for me. Like, how can I have full confidence to trade with a lot of size when I'm using that as the starting point? And it's not only just like a rule, it's like the basic starting point for a strategy. So
Mhm.
that's a big red flag for me.
So I'll take a little bit of a different side of it. So first of all, if you are going to do any of this, just a caveat right off the way, you have to have data that includes survivorship bias, which means that, right, if you are testing, say, on the Nasdaq 100, just to make it simple, right, it's going to be the one largest 100 tech names at the time. If you're testing 5 years ago, the Nasdaq 100 is going to look slightly different than it does today. If you're testing 20 years ago, it's going to look wildly different than it does today. So a lot of people don't even account for survivorship bias, which is I'm going to test my system on all the things that were kicked out of that Nasdaq 100. So that's huge, right? I use Norgate for that. They handle it really really well. And for when it comes to kind of systematic trading, and when it comes to testing, I think that solves a lot of your problem right off the bat, because you're testing against a universe as it was at each moment that you're testing it at. So the SP 500 is just going to be your largest 500 names in the SP 500, or in the U.S. market at any given time, and making sure that I'm including that bias certainly helps. But I totally agree. The part I totally agree with is that this is the whole myth of people think that there is such a thing as passive investing, right? There's not. It's the S&P 500 is a system, and it's kind of like a really good argument for systematic trading, where they're saying that they think that the most impactful value of a company is its market cap. So when your market cap grows to a certain size, you get brought into the S&P 500. And if it shrinks to a certain size, you're kicked out. And even on weighting, it's weighted higher the higher your market cap is. So they're just using a almost like a single variable system at that point. It's like a rotational
Yeah.
system that uses a single variable. So that's kind of, I'll just get started with saying we are gonna, I think, have some disagreement basically around time frame. But yes, if you're gonna go down this road at all, it's an absolute must. You've got to have that survivorship bias data, or
Yeah.
you're fooling yourself.
So I totally agree with that. Yeah, that is an absolute requirement to have. So, and on one hand, hey, that I think that's the requirement that you have that is already going to weed out a bunch of people, like a
Hmm.
bunch of your competition. And just that there's that hurdle there sort of makes that somewhat attractive, because you just know that some people aren't going to realize that they're going to just use the S&P in the current way, and they're going to be inefficient traders by doing so.
Hmm.
Um, so you bring up another good point there. With the S&P 500, it's weighted as well as just inclusion. So it's not a simple yes or no that you're in the list or not. It's that you're in the list with a certain weighting, correct?
Yes, for the S&P 500, there's the RSP, which is equally weighted. But yeah, so to get into the S&P 500, there's a couple criteria, but the main one is, are you one of the 500 largest stocks
Yeah.
in the US?
So then I would, so you're already going from a starting point that you're already reducing. We talk a lot about a continuous variable versus a binary. And
Hmm.
using a symbol list is 100% a binary. And you're already going to be losing precision in your strategy. And I think it's just going to be an inefficient way to create a strategy. Now, can you create a strategy that way? Can you use that as a starting point? I think you can, but you're leaving a lot of money on the table by doing so.
So, so two different worlds. So let's separate them out because I'm going to be full in agreement for the day trading side of things, right? Where you're essentially you should if you're running a purely or 99% kind of let's say technical setup, right? You don't care what the fundamentals of the company because it's a day trade. You're in and out in a day or an hour. Who cares anyway? That should be done on as many instruments as possible. So you should probably just use the full equity list for that. However, you're always going to be filtering by some metric. Like I'm sure you have in all of your setups some volume requirement. You don't want to be looking at stocks that do zero shares for a day. So you're doing some filtering yourself. So the question I would kind of ask that person is, what is it that is appealing to you about S&P 500 names? Because if it's just that you think it's going to work better on larger, more liquid names, you could kind of do that filtering yourself, right? Just by adding a market cap and a volume filter as well for the day trading sides. Now, for the swing trading side of things, the thing that I like about running it against universes is that I like the fact that I am in a sense outsourcing some amount of quality filters. And if I'm going to be holding something for a week or a month, I understand that I'm outsourcing that universe filter. So for it to be in, say, the S&P 500, I know that there's a whole bunch of other nerds out there that understand this, whatever, the profitability of the company and the market cap and all that. I'm basically saying you guys do that work because I have the data going back to 1950 of everything that was in the S&P 500 at the time. I'm not so worried about the fact that I don't fully understand exactly how they do whatever because it's there. At the end of the day, it's going to be different for both, but it's going to be one of those things where the solution is going to be tested. Like, why not test it on both universes and see which performs better in the long run?
Yeah, well, a symbol list is essentially a filter.
Right.
And by definition, this filter is a 0 or a 1. Now, we've talked a lot about this exact problem and why you shouldn't be using a binary filter 0 or 1, that you're losing a lot of precision by doing that.
Hmm.
But yeah, here we're talking about, yes, we're using this as a 0 or 1 to whether it's on the symbol list or not. And you bring up the important point, I think, which is is this the best is this the best filter to apply? And when you go back to your system, I don't care what time frame you trade on, swing trading, investing, you're getting in for a reason. And that reason is the signal. And if you're telling me that signal, the most important factor is whether they're in the S&P 500 or not. I'm not buying. I think your system should be better. Like it's like like here's an example. Like put it in your back test. Like just like we talked about before. Take a back test.
Mm-hmm.
Do no filtering. Put a column in there for 1 or a 0 in the S&P 500 or not, or whichever one you want to use. Put it in the strategy cruncher, and that darn well better come up as important in the strategy cruncher. And if it doesn't, then that would be a big red flag for me. I would think, okay, why in the world would I be using that?
Well,
If
yeah, and I
there's
think,
another factor that's obviously more predictive.
and then that's to my point of testing. So there could be limitations, for example, of going back 20, 30 years and getting the market cap for each individual stock. Like that could be a problem, right? So again, so you're kind of outsourcing market cap requirements to the Russell 3000 or something. That could be something that you're doing. And yeah, it should be as simple as let me run this universe on the entirety of stocks and get results A, and then let me return it on the S&P 500, whether it's not it's in it, and get results B and see if that improvement is that significant. But again, at the end of the day, like you mentioned, you're filtering names. So the question is, A, do you have the ability to filter names by market cap if you've determined that market cap is important to your system? Because I do have some that I use a dollar volume for a kind of a way to say, hey, it's liquid and people care about it.
Yeah.
So there is that kind of premise as well. And then also the likelihood, and the other reason people may use filter sets like S&P 500 or NASDAQ inclusion is the overnight hold and overnight risk. So if I'm holding any stock and I can't look at the market cap of it, or I can't test the profitability of the company or something like that, or their cash amounts over long periods of time, because that data is hard to get. By outsourcing and saying, okay, well, if it's in the Russell 3000, you can just do the math and you can see the studies. Way more likely that a company outside of the Russell 3000 goes to zero overnight than one that's inside the Russell 3000, right? Not impossible. And then way less likely again that a stock that is in the S&P 500 goes to zero overnight, as opposed to a stock that's outside the S&P 500. So just to show you, that's why people, generally speaking, for swing trading and long-term investing will use these filters, is you're essentially just saying, I can't get the profitability and the their profitability type data and market cap data myself very easily. So I'm just going to grab the Russell 3000. But that's still going to include, I think the Russell 3000 is like 97% of the investable universe. And you talked about the Wilshire's 5000. There's not even 5,000 stocks in the Wilshire 5,000 anymore, because there's not 5,000 tradable liquid names.
Yeah.
So I think it's a really different conversation if you're talking about the Russell 3000, which is 97%. You're basically excluding like OTC and penny stocks out of the Russell 3000, versus someone who's saying, I'm only going to trade like the NASDAQ 100. Or I think we can both agree the absolute cardinal sin was, I'm going to pick a basket of my own stocks to test again. I think that is, you've really done something bad then, because I've seen people do that all the time. I'm going to test my setup on NVIDIA, Tesla, Apple,
Yeah.
whatever. It's like that's taken to the extreme that I think you're really, really kind of hurting the data at that point.
Yeah. I think if I can maybe understand if you're holding for a long time, the closer you get to being an investor, but
Mm-hmm.
I just there's so much more money to be made on a shorter time frame, and there's so much more of your account that you can turn over by making more trades. It just doesn't make a lot of sense to me. And it would be, for the world I'm in, the inclusion in the S&P 500 is never going to be important.
No.
Just never.
Well, and
And
let's just go. So I have three buckets of systems that I run, right? And I try to run all of them. So I have day trading systems, which I'm building out and trading actively now. They include everything, right? And then the swing trading systems, they also include everything, but with more stringent filters on things like dollar volume and interest and all that, because I don't want to buy a stock that goes nowhere for a couple days. And then I have investment systems, and I have those. One is a basket of ETFs, a universe of ETFs, and then the other one is based off the Russell 3000. So they're never super limited universes, but as the time frame goes out, the filtering comes in, and I wouldn't use any of those filterings if, for example, for the investment ones, I could go back and look at things like market cap and profitability and metrics like that that I don't think are predictive in nature. They are just more protective in nature, if that makes sense. If I'm going to hold a stock with, I'm going to put $20,000 in a stock and hold it for a month, I'm going to be way more comfortable if that company has a couple bucks to its name or makes a couple bucks, as opposed to something that is, just this OTC whatever that could be a complete scam. But for a day trade, I don't care, because the odds that it's going to go bankrupt intraday are much much smaller.
Yeah. So there's a couple of things I think about here. One is, when you're creating strategies, we know that you want to minimize the number of rules.
Mm-hmm.
Like if you set out to curve fit, like that was your goal to overfit, what would you do? You would add a whole bunch of rules, right? So you know that to avoid curve fitting, you need to add as few rules as you can.
Yeah.
So right away, we're adding a rule here that we've already said is not super predictive. And so it's already somewhat arbitrary. So, and you're basing your whole strategy on that. So why isn't this not like you're setting yourself up to curve fit right from the very beginning?
Because it's another filter set. So just like right from the very beginning, I'm sure you put some non-zero volume amount on it, right? It's just the same way of saying I'm putting
Mm-hmm.
some non-zero market cap amount on it. That's the way I look at these filters, is that because if you look at it, there's the IWM, which is the Russell 2000. That's from 2 to 10 billion, and the mid caps is what, 10 billion to 50, and then the large caps 50 billion up. So all you're doing is, instead of bucketing by volume, which everybody does all the time, you're also just bucketing by a certain amount of market cap and profitability. So again, my answer is always like test it. But if you're finding that your test runs way better on the S&P 500, then you're probably saying, well, for my hold time anyway, some amount of profitability or stability of the company, cash on hand, whatever it is that leads to that market cap, is important for that. And quite often, when it comes to things like trend following and longer term stuff, you'll notice that that's the case. It's not your junky penny stock that jumped up 200% this day and is going to fade its way back to zero. That is something you want to hold for a month. So that's why in different universes it makes sense to, right, potentially look at different names. If, again, you could get the data to say, okay, which one of these, is it market cap, is it profitability, is it cash or whatever? If you could do that, that would obviously be better. You'd split those out. Just again, for long periods of time, for long periods of history, I think fundamental volume or fundamental data is super hard to get compared to like even technical data. So
Yeah, I think that's true. Um, so you do bring up another point, which is you even said if it's not in the Russell 3000, there's a much higher chance of it going to zero. Well, you just sort of stumbled upon a very good trading strategy there
and
by excluding good, quote unquote, good companies.
mhm.
So that is a case where I could actually get behind something even for day trading, is excluding a list of stocks that
Well,
but I would say typically that's on the short side, but
I would argue even on the long side. So I know a lot of traders, for example, will do the same thing with, and not necessarily, again, if you're doing it short term, not necessarily because of an inclusion to a list, but it's every low float trader you ever talk to. They're not going to be trading Nvidia or Apple or
Mhm.
whatever. They specifically filter their universe by let's get the big stuff out of there because we know it's more efficient. It will generally speaking be less volatile. Now, sometimes they're not even doing that by putting in a multi market cap filter. They're just
Yeah.
saying, rank the stocks by how volatile they were that day and naturally kicking those names out. But yeah, I've met a lot of traders say, I just only trade low cap stocks. So by definition, they're putting a filter on a certain amount of market cap, and they're just doing the opposite of what we talked about with the day trading or the swing trading side of things or investing.
Well, I think that a lot of low float traders aren't actually putting the filter in. The definition of their strategies just automatically gets rid of anything. Like no uh, really big name is ever going to move like 100% in the day. So it's just never going to show up in a lot of these strategies that people trade. So yeah, they're not specifically doing it, but they wouldn't turn their nose up at it if Nvidia went up 100% in one day. That's probably too high. That's probably a good short.
Yeah, and that's what I'm saying. But like, let's say they had three stocks that went up 100% that day, and they could only pick one. It may be not a first filter; it could be a second or a third filter down the list. And
Yeah,
that's the same thing I would say. So when I kind of talked about the dollar volume as a way for me to find kind of
yeah,
established names, that is a way again to kind of try to accomplish the same goal that this guy might be trying to do, but just do it a little bit differently. And by dollar volume, again, for the audience, it's just the share price times the volume, and you just take an average of that. And the idea is that if you're a very high dollar volume stock, it just means that there's a lot of money changing hands in your stock
yeah,
every day. Generally speaking, you'll be just by definition or by nature of it, you'll be a higher cap name, right? Apple is always Apple, Nvidia, all these are going to be the highest dollar volume names every day. So yeah, it's one of those for a proxy, again, okay.
yeah.
If you had an alternative, I would say it's okay. So yeah, so it's one of those things that there's probably a
So,
better way to do it, but for a proxy, I don't think it's bad at all.
so have you thought about, we talk, as we mentioned before, we've got a binary 0 or 1. It's either in the list or not. So does Norgate or any other service provide the weighting over history? And is there a way to backtest on the weights?
I think you can get that. I don't know why that would matter that much unless you were looking for because there's subsectors. So say you only wanted the 100 largest names. There's the S&P 100, right? There's the S&P 50, there's the S&P 250. So you could definitely filter by, quartiles of the largest names out there throughout histories. And if that really mattered, then yeah, I guess. But like we talked about, every
Well,
time you do that, you're going to be limiting trades, right?
yeah, but uh, I think about the edge of the list. Think about the bottom edge of the list and how arbitrary it is.
Hmm.
Uh, and if you're like you've said that, hey, this is the list is set up, but here's the definition. And on the very edge of that list, and you even said like the Wilshire 3000 or whatever doesn't have, or 5000 doesn't have 5000 names in it anymore. Just, well, that's completely arbitrary. Like just think of the bottom part of that list. It's completely arbitrary whether it's on or off the list. And um, so it has to have some difference, like the top end of the list versus the bottom. I mean, that's the whole reason you're using the list at all. So it seems like to ignore the weighting would be, it just seems crazy, right?
Well, think again. Let's use the volume example, right? Again, in your strategies, I'm sure you have an arbitrary volume cutoff. You had to pick a number at some point, right? Now we're talking like Loki's wager stuff, right? At some point, you have to pick a number to say, if it did less than 50,000 shares, it's off the list, and if it did more than 50,000 shares, on the list. So at some point, there was a cutoff that should have happened. So it's one of those things where you have to do that cut at some point, and they're just doing that cut based off a metric like market cap as opposed to something like volume. right?
Yeah, but I think that I look at I would call that like a universe filter where um, I'm, it doesn't actually come into play that much, but it is like a floor below which there's a lot of risk there. And I know there's a lot of risk. So I'm saying use a floor for that so that, uh, your risk isn't too high below that. So, but I think
And
that's
that's
fundamentally different. I think it's fundamentally different though from the S&P 500. Like that is, you're saying that's a completely different type of filter because you're saying, hey, here's this filter is it's absolutely going to come into play every time. And so in my mind, if you're using a filter like that and it's like doing what I call like doing a lot of the work for the strategy, it better be dang predictive.
yeah, again, a predictive, or again, like we talked about, protective, right? Making sure that you're not going to zero overnight. But I would say it's kind of essentially the same thing. At the end of the day, the only thing that I kind of see your point on it is that the the S&P 500 by definition only lets in 500 stocks. Right. So it's not that it's cutting off at a hard market cap number. It's cutting off at a number of stocks. So
Yeah.
that's why I say it would be better if you determine that market cap is important to your trading strategy, that if you could get that data, again, with survivorship data going back far enough that's interesting to you, because then that may fluctuate anyway from, 500 to 1,000, right, or whatever. It could fluctuate around a number. But again, at the end of the day, at some point, we are always kind of putting our foot down and cutting off and saying above this number good, below this number bad, whether we want to or not.
Yeah.
It's just something that for a day trader, I don't think should matter at all, which is market cap. For somebody who's holding for a long period of time, it should. And then the question again is always, what is a proxy for that, right? So I would kind of go back to the user and say, what I bet you there was a comfort feeling of potentially trading only the S&P 500 names that he
Yeah.
got from, okay, these are big names, they're real companies, they're not going to do anything, insane. And just saying, okay, could you replace that? Could you just add a whole bunch of volume and then like a low ATR and get roughly the same,
Yeah.
90% of the same comfort while still allowing a little bit of a more dynamic list?
Yeah. I'm sure. I'm sure it fundamentally comes down to day trading versus swing trading because just when you say you want to make sure that a stock doesn't do anything insane, like that's the whole point of creating a strategy. Like you want it to do something insane, and then figure out how to trade against that, or wait, find the stocks that are going to do something insane. That's where you really make money, and uh, so to me. I could never use the S&P 500 for day trading just because you're limiting yourself arbitrarily, and there's a whole bunch of like your strategies are necessarily restricted, and you're closing yourself off to a whole lot of money by doing so.
Yeah, and again, I think it's we've kind of nailed in the big thing is that there's certain strategies that you do want your stock to go crazy, and there's certain strategies or certain time frames, I guess, defined better, that you won't, right? If I'm holding a stock for a period of time, I'm placing a trade once a month, right? I've got a bunch of other stuff to do, and I'm just placing a trade once a month, then I better, you talk about all the time, path to confidence. I better be confident that I can hold that particular stock for a month and not have to check on it every day, right? A lot of the traders I deal with, I know you're kind of exclusively dealing with pure professionals that are trying to do the trading for a living. And I deal with some of them, but and then I deal with a lot of people who are dentists, doctors, plumbers, lawyers, whatever. And if they have a portfolio of stocks that they're going to trade and hold for a week, they want to make sure that it's not, a company that, like all of these companies now, just it's going to date the podcast a bit. You're seeing these companies triple in value because they're taking out giant loans to hold Solana. And there's one company I think that's up like 500% in the last 2 weeks. They were doing it. If I'm there's one gentleman I know who's firefighter, and he's like, I can't be on the job putting out fires worrying about this crazy company, so he has to trade longer and slower. So for someone like that, he might just have that path of confidence to be better at holding something that he's got some confidence in is a real company and is not inflated value because they're YOLOing Fartcoin. And the with to do that systematically, sometimes the best way to do it is just to say, right, give me the Russell 3000 or the Russell 1000 or some giant basket of stocks that are at least legitimate companies. Now, for day
Mm-hmm.
trading, again, who cares, right?
Okay, so you mentioned it earlier in the podcast, how it's really bad, you believe, to come up with your own list and just trade against that. So let's talk about that. Why do you think that's so bad?
Well, that's just all kinds of biases. We could list them, right? So there's survivorship bias and regency bias, and right, there's all kinds of biases in that. And the reason I think for a lot of that, unless it's something that you are absolutely sure has A, existed for a long period of time, and B, will exist as something you're going to trade for a long period of time, I think it's a bad idea. So, an example would be Apple. There was a time I know a couple traders, and that's all they did. They just traded Apple. That was their whole
Yeah.
thing. But then Apple became this giant mature company that stopped moving, and their systems would have degraded away to zero or kind of negative at that point. So I want to differentiate that a little bit with people who just trade like the S&P 500 as a whole, because that is always going to kind of be around and has already been around. If there's ever a day that we wake up and the S&P 500's gone, we should have spent our time learning to grow potatoes as opposed to trading the market. But yeah, so you're bringing in all these biases and you're building a list of stocks that were volatile in the past and were kind of the in crowd at the time, and you just have no way of knowing systematically if they're going to continue to be that way, or if it's the day that you include them in your little system they're going to stop.
Okay, so here's another question. Do you, and I totally agree with that. Um, I know some traders that will, even day traders, will look at their results and say NVIDIA just doesn't work well in their strategy. They've seen it show up
The shit list.
a bunch of times. It just doesn't work. It's
Okay.
there's an inordinate amount of losing trades for one name, and so they take it out of the system. What do you think about that?
Yeah, well, it's a shit list, right? I think everyone at some point has done it. Now, from a systematic point of view, it doesn't make any sense, right? It's just not mathematically. I believe, and I think you'll agree with me on the right answer is try to figure out why, right? Does that stock have some characteristic? Again, market cap we're always hitting on. So is the market cap too big? Is it, is it maybe a specific industry of stock? I know people, for example, who hate trading like commodity stocks because they find they don't have the same move, so they're looking for stocks that move faster. And that, like, is there a different way to filter it out? Path to confidence, being a human being, mate, what's one stock? If it makes you feel that much better, maybe, but you have to know you're fooling yourself at that point, just because you've touched the stove too many times, and the next time you touch the stove, it will probably be cool, but you're just kind of mad at that point. So
Yeah,
mathematically makes no sense.
I tend to agree with that. Yeah, totally agree. So there's one scenario that we haven't talked about where I do use symbol lists,
Oh,
and I think this is going to be pretty common. But if not, you should think about this. Um, I use it to exclude ETFs. So a lot of the strategies I run, I'm specifically excluding ETFs from that list. So in that case,
it's gonna be a long
uh,
episode because we're gonna be fighting back and forth on a lot of stuff.
so you don't like that, huh?
Again, well, like we talked about, the guys who do the low float trading, but they don't necessarily exclude low float. They're not putting a float and they're not putting a market cap in a scan. It's just they're doing it by subjects of it. Who cares if there's two things that I think that we'll hit on with this, but the first one is who cares if the oil ETF is gone crazy because something absurd has happened and it hits your scan. If it has predictive value, if your idea has predictive value, maybe a commodity has just gone nuts that day. Uranium, I remember after Fukushima, like you can look at that candle. It was crazy. There could have been some excellent day trading opportunities or even short term swing trading opportunities in the uranium play. So by removing ETFs, you're potentially removing, you'll probably get some companies that are involved in it, but you could be removing something that, on a very rare circumstance, I agree for most of the time, you could be excluding something that's awesome. And shouldn't you, just like you said, you shouldn't filter your universe by market cap? Shouldn't you also not filter your universe by whether it's an ETF or not?
Yeah, I think that's I don't do that for every strategy, but there's some moves that, like, there's some strategies I have where it does come up, like these names do come up in the strategy, and it's a little like a juiced ETF for like the Nvidia, the juiced Nvidia or whatever.
That was actually going to be my second point. Why not? Right?
Because if it's juiced and it comes up on the strategy in my criteria for a certain strategy, it might be simply because it's juiced. So I don't want like and it's going to be juiced by like that. That's going to be sort of more normal behavior for that name. So I can see with some, I could just see with some of my strategies, they're it's like in baseball when you're hitting foul balls. Like you're not hitting home runs with it. You're like hitting foul balls. You're making contact, but you're not hitting home runs. So I feel like and it's kind of hard to explain, but I feel like some strategies I see sort of make contact, but they're foul balls. So, think about if you didn't know the rules to baseball and you were up there and you started hitting and you hit foul balls every time, you would think like, wow, I'm doing great. But you're not even like, you're pretty much striking out. You're not hitting the ball in play. So I feel like I feel like in these cases with certain strategies that I trade, it's good to exclude ETFs for that reason. It's
If you're
not like I wouldn't say it's what like makes it profitable or makes it successful or not, but I do feel like I exclude some foul balls by doing it with this particular class of strategy.
so two things to think about. Like one is, so if you're doing a good job normalizing your data, shouldn't the fact that it's a juice ETF be just taken account for? And it will only show up if it was an exceptionally large move on that juice ETF that day. And the other one is, okay, what if the stock is doing something? So for example, I just brought up HIMS. So they male enhancement, let's say, was down like 30% the other day. It showed up on one of my systems. HIMZ, which is the double leverage one, which I wouldn't have seen systematically, had a 70% move, right? So, if I had excluded ETFs from that, maybe I would have traded the underlying that still had a massive move that day. But by excluding the ETF, I missed out on a double percentage move, which either means more profit or less capital allocated to get the same profit, right?
Yeah.
So those two things are kind of what came to mind when you were talking there. Is that, yeah, normalize the data correctly should be the same, and then if you're getting more juice for less of the squeeze, and who cares if it's an ETF or a stock?
Yeah, I'll have to think about that.
Because
Yeah,
well,
I'll have to think about that. But I do know that it's not a huge mistake, like
no, it's just
to exclude them
well, and
if it is at all.
we're circle it all way back around, right? Is it's just like it's probably not a huge mistake to look at the Russell 3000, which is 97% of the investable universe, or the Wilshire 5000, which is 97% of the investable universe, as opposed to the entire stock market. You're probably, if you run both of those simultaneously, it's you're not, the difference isn't going to be one strategy kills it, the other strategy is awful. The question you're always asking yourself by excluding anything is, am I excluding
Yeah.
something that could eke out a little bit more profit, right? So I'd say excluding the ETFs is the same as including something else, right?
Yeah, I'll have to think about that. I'm going to go back and look at ETFs versus not ETFs on a couple month strategies and see, because it has been a bit since I've looked at it. So
Well, and this is,
yeah,
we should talk about these single stock leverage ETFs are a newer phenomenon and something that I'm exploring heavily because it is a newer phenomenon. So we've talked about this
yeah,
privately that for like bots, I would love every time Tesla, if it comes through the system, is replaced by a double leverage ETF with like half the size, and right, because
hmm
I think these are amazing tools that are just, there's not going to be a huge amount of data on because this whole like this mega degenerative stuff has happened in the last couple of years. So it might be one of those where that as you're doing this data, you're spending a little bit more time focusing. Leverage ETFs are not new, but leverage ETFs in individual names are way
yeah,
newer.
yeah. That would be interesting. I'm not sure. Do you know if there's a way to categorize uh, whether something is a leveraged single name ETF versus just a regular ETF? That'd be interesting to see if you could categorize those and get those quickly without going through and examining each one. Is there a list of those that does that categorization? That'd be interesting.
Yeah, there would have to be something out there, but I think there is. And the problem is they're coming up all the time. So these guys are
Yeah.
chasing the dragon with this. Like there's now one for quantum computers, and like quantum computers aren't a thing,
hmm
but the companies are on fire. So then every time you get volatility in the company, they launch a leverage ETF. Because one of the things that I was exploring that I thought would be interesting is by the time the leverage ETF is launched, is that the end of that particular run in that name? The Yeah, the idea is, like, could you end up going through and saying, hey, this is one of those cycles? Because like for example, they delisted the coal ETF, and that was the bottom of the coal market for like the last 5 years, and
hmm
it's the classic magazine cover indicator of by the time the news is talking about it, right, that it's the end of the move. So it's a very interesting universe, and again, it might be one of those, you built the strategy before this existed, now you go back through and you find that over the last few years you would have done better. But I would encourage everyone just to take a look at those as well. But it's funny that it's, whether you're excluding or whether you're including stuff, we're kind of coming back to the same idea, which is likely suboptimal. Not necessarily bad, but if you could figure out a different way, might be a little bit better. But if it works in back testing, it's probably not the worst thing in the world.
Yeah, yeah. I'm curious now. Um, yeah, it's super interesting. This is. I knew this is going to be a good discussion, but I didn't think it would be this good. Yeah, this is great.
Well, and so again, to go to a different episode of the podcast we did for a while about building your own trading group. I think this is the kind, you just saw a little bit of the value of that, of someone who just doesn't. There's mentor mentee relationships where the mentee just usually listens to what the mentor says and maybe asks some questions. But then there's finding people that are your peers, and they might give you a little bit of pushback, and or say, have you really thought about this? Have you done that? And doing it off social media where you can do it in an amicable way where you're not like, right, instantly hating the other person because they disagreed with one small thing you said. These kind of trading groups, I think, are important because, yeah, me and Dave talk a lot offline as well. And yeah, quite often you can go, I didn't think of that, let me go back and give that another try, or change some things here or there.
Yeah. So yeah, kudos to that. That old podcast we did, which I still think is one of the most valuable ones we did. I think it's called Create Your Own Trading Group.
Hmm.
We'll link to it in the show notes. But yeah, yeah, definitely a good one to go back and listen to.
We stumped Dave, guys. Come on, we can give a round of applause. We got him thinking. He's
Yeah,
just
got
about
me
to.
thinking. I love thinking. So there was. I just heard from a listener. I just got an email this morning from a listener. New listener. He said, "Man, um, he said, "Wow, I can't believe I didn't know about this podcast. I've been listening to this on my commute. I don't always agree with everything, but a lot of what you said has confirmed what I'm already doing." I was like, "Oh, let me know when you don't agree with what we say." That the most interesting discussions come out of that. So,
Hmm.
and yeah, next time that happens, send me a note, and I want to hear about it. Let's talk about it.
Well, and also because neither of us pretend to be like these mega gurus that have it all figured
Yeah,
out, and we're not. That kind of thinking, I think, kills systematic trading. As soon as you're like, okay, I got it. This is my setup. This is the thing I do. You've just stopped any further progress. And when that thing that you're doing ends up stop working, or performs a little less optimally, or even if it keeps going forever, you're still leaving a bunch on the table, not doing different things. So
yeah,
I'm the same way. I love questions and pushback and that kind of thing, because I'm not going to be one that I'm going to fight and say, oh, you're wrong or you're dumb or whatever, unless what you're saying is dumb. But it always, if anything that's brought thoughtfully should be considered thoughtfully, and like we talk about all the time, idea generation is kind of the hardest part of this whole game. So, that little conversation we just had, now Dave's got some ideas and we'll go test them. Turns out he could be right, and excluding ETFs is the way to go, and that's fine. That could open up a whole other door of questions that he needs to ask. Or he could find that with recent changes to the market and with these new single stock ETFs, that there's a little bit of unexplored edge there, and that answers a whole bunch of questions as well, right? So yeah.
yeah. So the first thing I'm going to do is go look at the ETFs, and here's a good thing to point out. If you find something that is improved by excluding something like this, like we're talking about, like
Hmm.
let's say that does work, there's usually some edge on the opposite side for that excluded list. So very often it is a kernel of, like, when you're able to exclude something and improve what you're doing, there's a kernel of a strategy there on the opposite side with what you've excluded. So this is exactly how, like, these kind of tough questions that you're asking me and that you ask yourself,
Hmm.
this is how you get better, and this is how you turn one system into two systems, and you continue to do that and just get more ideas. So and the more strategies you get like that, the more ideas you will generate for yourself. So it sort of self perpetuates.
Yeah, and yeah, I think the perfect example of that was when we were talking about the stocks that are not in the Russell 3000, those junky
Yeah.
stocks that can't even make that right. They're probably like that for a reason, right? So yeah, that might lead a whole path down to, what if I only look to short stocks that are not in any known index because they're such crap they can't even make it
Yeah.
into the worst possible ones? Then right, that ends up opening this whole other door of things that you could do, and then you can either take that and apply it to existing. Maybe you already have a short strategy, then it'd be very easy to say exclude everything from the Russell 3000, test again, see if it's better, or building a new strategy. So yeah, it's always conversations and questions lead to more questions, lead to more conversations, lead to more questions. And that's why, again, I think we love this style of trading, because it's way more of an intellectual pursuit than, let me guess what's going to happen next on this one stock in this one trade, and either be right or wrong, mostly because of luck, and then right,
Yeah.
go and repeat the same process. It's not nearly as cerebral, I think, as talking about the whole theory and edges of the market and things like that.
Yeah, I think you said the word luck. I'll use the word gambling. That's when it comes down to it. That's what a lot of people do that aren't systematically trading, whether they admit it or not. And
Hmm.
that's a big part of what draws me to systematic trading, is that I know it's not gambling.
Yeah,
There's some luck involved, but it's not gambling. I can tell you that. That's
yeah.
probably a whole episode we could talk about.
All right, we'll write it
Uh,
down. So
yeah,
no, that was a great one. Again, thank you all for the question. Can summarize, probably not ideal to filter anything, but if you don't have any other way to do it, right? If you can't find a metric in order to do it, then give it a shot, right? And at the end of the day, a lot of these answers are test it and test it both ways,
yeah,
and that will either answer the question or lead to a couple other questions about why. For me personally, if I tested something and it just completely fell apart on the entire universe of stocks, but did really well on the S&P 500, that's not an answer. That's another question of, right, why, and then,
Yeah.
where can I stretch the boundaries? What can I play with? If I can't find the data that makes up that difference, then maybe I'll use that constituency just to, as a data proxy, for lack of a better term.
Yeah. Yeah. Love this.
It's great chat, and until next time, I'm Michael Noss.
And I'm Dave Mabe. We'll talk to you next week on Line Your Own Pockets.